Many people are dreaming of the day that they'll be able to earn enough passive income to retire comfortably, but the real question is to know how much money exactly do you need to have invested in the stock market to generate enough passive income to fuel your future dream life. This is the question that I'll be answering in this video, where we'll find together how much money do you need to have invested to retire off your dividend income. Before to find how much money do you need to have invested for your retirement, we need to find what will be your financial needs at that time. Some people have the aspiration to finish their life in their small $5 million mansion, while many minimalists will prefer to live in a small cottage to enjoy the calmness of the nature. Everyone is different and everyone has different objectives. It is why it is crucial for you to fix yourself some objectives on what will be the budget that you'll need during this period of your life. If you're currently comfortable with the lifestyle that you have, financial planners recommend on average to plan for about 80% of the income that you are currently making in that case. This means that if you're currently bringing home annually $100,000 and that you're satisfied with your lifestyle, you should be aiming for about $80,000 of retirement income. However, keep in mind that another important factor to input in your equation will be the inflation. Over the last 4 years with the pandemic, we've seen the impact of this global effect on our wallets, where long gone are the times where you could make your grocery shopping for less than $100. This means that while your $100,000 annual salary might be enough for you at the moment, this might not be the case for the next 20 to 30 years. However, for the basic guideline of this video, we'll take in consideration that your objective for your retirement will be to generate $100,000 of dividend income per year. Obviously, if you have higher or lower expectations, you can adjust the calculus with your personal needs. But for instance, as we can see on this graph, the average retirement savings account balance in 2022 for the people aged between 55 to 75 years old was between $500,000 and $650,000. However, as you will find later on in the video, this average might not be the best if you want to be able to cover all your future objectives. Plus, it is important to note that this average retirement savings balance isn't including all the pension income and the different other revenue that you'll be able to generate at your retirement. However, for the average person, the universal rule when it comes to retirement is called the 4% rule. This rule suggests that retirees can safely withdraw the amount equal to 4% of their savings during the year they retire, and then adjust the inflation each subsequent year for 30 years. With this goal, we can find that if your objective is to earn $100,000 of dividend income for the next 30 years, you will need to have about $2.5 million of assets invested in the stock market. Obviously, it is clear that this rule can be modified depending on the age of the retiree. For example, the timeline of a retiree of 40 years will not be the same as the one of 70 years. This means that the younger you aim to become a retiree, the more assets you need to have invested in the stock market. This rule of thumb is optimal for most people, but in fact, there are also many great income-oriented options that will help you to maximize your dividend income. While this rule is telling you that you should be safely able to withdraw 4% of your total assets per year, there are other solutions that are able to give you over 8% of dividend income per year. A fund like the Hamilton Enhanced US Covered Call ETF is a perfect example of it, where it is giving about 12% of annual dividend that are paid on a monthly basis. And so by using covered call, this fund is able to distribute per month about 13 cents per share, which actually represents about $1.57 per year. And so if your objective is to generate $100,000 of dividend income per year, you simply have to divide this amount with the annual dividend income that is distributed per share from this investment vehicle. And in the case of this fund, you need about 63,614 shares of HYLD. And so with their current price, this would represent an investment of about $818 $100,000. And so as you can see, this type of option obviously requires quite a lot less capital compared to the classical 4% rule. However, in that case, keep in mind that this type of investment will not be focusing on growth, meaning that it might lose some total value over the next couple of years if you decide to invest in it. Another interesting option for you would be to also invest directly in individual dividend stocks to generate $100,000 per year. For example, a great insurance company like Manulife might be an interesting option for you. And on their side, by having a 5% quarterly distribution yield, this means that to achieve a $100,000 dividend income annually, you need to have about $2 million invest in that stock. And so this would come down to about 62,500 shares of MFC. The great thing about these options is that you also have the opportunity to reinvest all the dividend income that you receive to buy even more shares of it. And it is the strategy that I personally have with most of my dividend stocks, where I am able, notably in my TFSA, to reinvest all of the dividend income to buy even more shares of those companies. Obviously, the dividend income of a certain investment should not be your end goal, since you should also prioritize growth, but it is definitely an important criteria in the process. To keep it simple, make sure to start investing as soon as possible, especially if your goal is to retire early. When we know that the average retirement savings account balance is of about $600,000, this means that with the 4% rule, this would generate some revenue for the next 30 years of about $24,000 per year. No wonder why so many people are stressed with the current global economic conditions with the inflation that is through the roof. It is why it is obviously important to start investing as soon as possible, but also to be consistent with the investment that you are making every single month. On your side, the easy part for you to plan for your retirement will be to calculate how many shares of this type of company or of this type of ETF will you need for the future. Simply divide the amount of money that you want to receive at your retirement per week, per month, or per year with the dividend yield that is offered by the different companies or ETFs in which you want to invest. However, on your side, the hardest part will be to determine what will be your needs for your future retirement. And so even if we say that the comparison is the thief of joy, if you want to find how much money should you be worth depending on your age, and if you want to compare yourself with other people of your age, well, check out the video that's gonna be right over here, and I will see you soon. Peace.